Moving overseas is one of the biggest decisions a person can make. New country, new job, new life. And buried in the excitement is something almost nobody thinks about until it is too late. Leaving Australia is itself a tax event. In some cases, one of the biggest tax events of your life, triggered without you selling a single asset. I am Tin-Lok Shea, tax lawyer at Australian Tax Experts. In the next few minutes, we will cover when your Australian tax residency actually ends, the exit tax on your assets, and the crucial choice it forces, what happens to your family home and rental property, and the obligations that follow you abroad. If a move is on your horizon, this is the briefing to have before you book the flights. 4 numbers to hold on to. 0%, the main residence exemption available to foreign residents selling an Australian home. Subject only to a narrow life events exception. Sell your former home as a non-resident and the exemption can vanish entirely. 15%, the foreign resident capital gains withholding a purchaser must take out of the price when buying property from a foreign resident vendor, with no minimum price threshold. 50%, the CGT discount foreign residents lose for gains accruing after May 2012. And 100%, the proportion of your worldwide income that stays accessible in Australia until your residency actually ceases. Every one of these numbers is manageable, but only from the departure lounge side of the journey. Start with the threshold question. When do you actually stop being an Australian tax resident? The answer is not when your flight takes off. Residency ends when you establish a settled, permanent place of abode in another country. A legal test, assessed on your circumstances, not your boarding pass. Many people who leave intending to live abroad remain Australian tax residents for part of the departure year, and sometimes well beyond it, particularly while home, family, or financial ties remain here. That in-between period matters enormously. Until residency ceases, your worldwide income, including everything you earn in your new country, remains accessible in Australia. Get the cessation date determined properly, because it drives both your Australian obligations and your foreign ones. Now to the event most departing Australians have never heard of. On the day you cease to be an Australian tax resident, the CGT rules deem you to have disposed of all of your assets at their market value, everything except taxable Australian property, which broadly means Australian real estate and certain related interests. Think about what that captures: your share portfolio, your managed funds, your foreign assets, all deemed sold on a single day at market value, whether or not you sold anything. Gains that have been quietly accruing for years crystallize on paper, and a CGT liability can arise at the very moment you are paying for an international relocation. But the law offers you a choice at this point, and that choice is the subject of the next slide. Here is the choice. Option 1. Let the deemed disposal stand and pay the CGT on departure. You crystallize the gain at today's market value, and in exchange, all future growth on those assets sits outside the Australian CGT net. Option 2. Elect to disregard the deemed disposal. No tax bill on departure, but understand the trade-off because it is widely misunderstood. The assets become taxable Australian property, which means Australia keeps taxing them, the whole gain, including everything that accrues after you leave, whenever you eventually sell. There is no market value step-up on deferral. Deferring is not escaping, it is staying in the net, with the bill postponed. Which option wins depends on your assets, your destination country's rules, and how long you will be away. Model it before you fly. This is a decision you only get to make once. Now the family home, the single biggest number in most departures. Australians are used to the main residence exemption, making their home tax-free. Foreign residents do not get it. Since the rules changed, a person who sells Australian residential property while a foreign resident loses the main residence exemption, and here is the brutal part. Loses it for the entire ownership period, not just the years spent abroad. Decades of exempt growth can become fully taxable because of where you lived at the date of sale. There is a narrow life events exception within 6 years of departure, covering situations like terminal illness, death, or divorce. But it is genuinely narrow. The planning point is powerful in its simplicity. Selling before departure, while you are still a resident, preserves the exemption. Timing that one transaction can change the outcome by hundreds of thousands of dollars.
What if you keep the property and rent it out? 3 things follow you. First, the rent stays accessible in Australia. Rental income from Australian property is taxed here, regardless of where in the world you live, so annual Australian tax returns continue. Second, the rates change. Foreign residents get no tax-free threshold, so Australian income is taxed from the very first dollar. And third, when you eventually sell as a foreign resident, the purchaser is required to withhold 15% of the sale price under the foreign resident capital gains withholding rules, no minimum price threshold, and send it to the ATO. You claim the credit when your return is assessed, but the cash flow impact at settlement is real and needs to be planned for. A few more travelers in your luggage. Your HELP debt comes with you. Student loan holders who move overseas must keep the ATO informed and continue making repayments based on their worldwide income. The debt does not pause because you left. The 50% CGT discount fades. Foreign residents lose the discount for gains accruing after the 8th of May 2012, with apportionment applying to assets held from before then. Another quiet cost of non-residency. And remember that as one tax system loosens its grip, another takes hold. Your new country has its own residency rules, its own tax rates, and its own view of your Australian assets. The two systems interact, sometimes helpfully, through a treaty, sometimes not. And they must be planned together, not one at a time. So here is the checklist. 4 decisions to make before the flight, not after. 1. Determine your cessation date. A proper residency analysis of when your Australian tax residency actually ends and what remains accessible until it does. 2. Decide the deemed disposal question. Pay CGT on departure or elect to defer, modelled properly against your assets and your destination. 3. Plan the family home. Sell before departure with the exemption intact. Sell within the life events exception, or hold and accept the consequences. Each path has a very different outcome. And 4. Set up ongoing compliance, rental returns, withholding arrangements, and help repayments organized before you leave, while everything is still easy to arrange. None of these decisions is difficult to make with advice. All of them are expensive to unmake. Let me close the analysis with the 3 mistakes we see most often. First, assuming departure ends residency. Under the domicile test, an extended stint abroad can still leave you an Australian tax resident, with your entire worldwide income accessible here, because the ties you left behind kept the connection alive. Second, ignoring the deemed disposal. Discovering CGT event I1 years after the fact, when the market values were never recorded, the election window has passed, and the records are gone, turns a manageable decision into an expensive reconstruction. And third, selling the home too late. A sale that would have been entirely tax-free as a resident becomes fully taxable as a foreign resident, the most avoidable 6-figure mistake in Australian tax. Every one of these is prevented by the same thing: advice taken before departure. This is work we do constantly at Australian Tax Experts, where tax lawyers and accountants plan departures as one team. We provide residency analysis, a definitive view of when your residency ceases and what remains accessible until it does. We handle CGT and exit planning, the deemed disposal election, the family home, and the timing of asset sales, modelled before you commit to anything. And we manage ongoing compliance while you are abroad. Rental returns, withholding and help obligations, handled without you needing to think about them from the other side of the world.
The savings from good pre-departure planning routinely dwarf its cost. Talk to us while the options are all still open. If you are planning a move overseas, contact Australian tax experts for pre-departure tax planning before you book the flights. Visit australiantaxexperts.com.au/contact to arrange a confidential discussion. Thanks for watching, and remember, this presentation is general information only, not personal tax or legal advice.